what we are facing right now is, again, we have a new administration that is delivering in the right policies in terms of the fiscal, but the cost that the population is bearing in the short run is clear. So we are in the midst of this process in which, without a shift in the way in which the opposition thinks the economy, it will be very difficult to exit the trap. So we have clearly a fiscal problem, but that needs a political solution.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
Welcome back to another conversation in our series of episodes that focuses on markets and investing from a global macro perspective. This is a series that I not only find incredibly interesting as well as intellectually challenging, but also very important given where we are in the global economy and the geopolitical cycle. We want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world may look like. We want to explore their perspectives on a host of game-changing issues and hopefully dig out nuances in their work through meaningful conversations. Please enjoy today's episode, hosted by Alan Dunne.
Thanks for that introduction, Niels. Today, I'm delighted to be joined by Nicolas Dujovne. He is the founder and CIO of Tenac Asset Management, an emerging markets macro fund. He was previously Finance Minister of Argentina between 2017 and 2019 in the administration of Mauricio Macri. He, prior to that, had a career as an economist at Banco Galicia in Argentina and other banks, and has been a board member for several corporations in Argentina, as well as being a consultant for the World Bank. Nicolas, great to have you on today. How are you doing?
Very well, and thanks for the invitation, Alan. It's a pleasure for me to speak with you here today.
Good stuff. Well, we haven't had a finance minister on before, so that's definitely a first. So fascinated to hear about your background in policy and in economics and markets. How did you get interested in economics and the markets in the first place?
Well, I think that I was strongly influenced by the long-standing history of instability of Argentina. So when I was a child, I was always thinking, why don't they fix this? We were always in the midst of, volatility on the FX, high inflation, quotas. I remember being a child and having to do, my parents having to do a lot of, stuff to get FX in the midst of capital controls, so as to be able to travel abroad. So I was raised in an economy that was dysfunctional, and I think that that generated my interest on the processes that led to that instability and how that can be fixed. And it's not a surprise that many Argentinians that are now in academia are tilted towards more to macro than to micro than other economists of the rest of the world. And maybe it's this interest in fixing the country. So I grew with a strong interest in politics and economics. At some point when I was at high school and was thinking on my career, my doubt was studying, going to a law school or to economics. And I was more inclined to economics. I really enjoyed maths, and that's why I think that I was tempted to study economics.
Very good. I mentioned, obviously, you're well known as being a former finance minister in Argentina, and you've already alluded to the fact that there's kind of long-standing cycles of crises in Argentina that seem to recur periodically, and we're kind of in the midst of maybe not a crisis, but a period of volatility at the moment. I mean, looking back at that experience now as finance minister, any kind of key reflections? Are the problems intractable in an economy like that, or can they be fixed, or is it very much, I suppose, the political side of things that's the challenge as much as the economic?
Well, yes, I think that Argentina has a political challenge on how to build a consensus around sound fiscal policies. Argentina entered into a trap. I think in the early 2000s. Prior to that, we had other problems in the past, but um, departing in 05, 06, the administration that was in charge at that time started to a process of increasing the size of the government in Argentina, driving the size of the government as measured in terms of GDP from roughly 25% of the GDP to 42 in just 10 years. So we almost doubled the size of the government in Argentina. Argentina is a country of middle high income, and countries like Argentina with that degree of income, well, typically they do not collect taxes for 40% of the GDP. You will not find not even one example of that. Typically, middle high income countries can collect between 25 and 30 something of the GDP at best. So having raised the government expenditure from 25 to 42 meant that Argentina had to finance its deficit. Well, uh, with the reserves of the central bank, once reserves of the central bank were depleted with indebtedness, and when we reach a limit on indebtedness, basically by printing money. Those three ways, the abuse of these ways of financing, generate a lot of trouble. But the root is fiscal, and to bring down again the size of the government expenditure to a level in which it can be financed by taxes. Well, you have a political problem, a problem that we experienced under Macri administration because we started to eliminate subsidies, and we launched a social security reform. And of course, in the short term, that can create some pain in the process of adjustment. When President Macri took office, the price of the electricity that the households paid covered just 15% of the bill. Okay, same for water provision, for transportation, urban transportation. In the case of the urban railways, in urban trains, the price paid by the users just covered 5% of the cost. So we started to correct these imbalances. At the beginning, that generates, well, a change in prices, a temporary raise in the inflation, while you are passing all these increases. And eventually, at some point, fixing the fiscal will deliver growth, and that will be rewarded by the voters. But it's a non-linear process, and after 4 years of efforts, we were defeated in the next election, and again, the people that drove the size of the government to double its level took office again, and well, they started to bring money, and well, finally they finished their administration in 2023 with 211% of annual inflation, and with the risk of entering into hyperinflation. But you can do a lot of efforts, but it's very difficult for the population to see the fruits of the effort in 4 years and to reward the administration that is delivering on the adjustment. So we need that the opposition improves also, because what we are facing right now is, again, we have a new administration that is delivering in the right policies in terms of the fiscal, but the cost that the population is bearing in the short run is clear, and the risk of the populism coming back to Argentina is preventing investment to pick up because the political risk is too high, and so the risk of a new default or capital controls, and so we are in the midst of this process in which, without a shift in the way in which the opposition thinks the economy, it will be very difficult to exit the trap. So we have clearly a fiscal problem, but that needs a political solution.
Fair enough. I mean, as you say, you do need to kind of circuit break these cycles, these virtuous and vicious cycles. I mean, one thing that you sometimes see, and obviously has been mentioned a bit, is dollarization, and that if you dollarize the economy, it would be a shock to the economy, I guess, but would be critical in bringing down borrowing costs and stabilizing inflation. Is that something that could change the overall dynamic or not?
Well, it's a possibility, but somehow thinking about dollarization is also like thinking in magic. First, Argentina does not have the resources to dollarize the economy because you have to, buy all the pesos circulating in the economy. But in the process of dollarizing the economy, all the peso debt that is very short term will be converted into dollars, and you will not have a buffer at the central bank for it to act as a lender of last resort. So Argentina is not in a position in which it can dollarize, and with the appropriate buffers to have the liquidity to convert the peso debt into dollar debt, and to have a central bank that can act as a lender of last resort. But in theory, let's assume that you have the money and you can dollarize the economy. Now the politicians will not be able to, overrule the equilibrium in the budget because they don't have the way to finance it. They will be converted into better politicians. And maybe, it's too ambitious to think that by just applying the magic of dollarization, we will shift the mindset of all the political system in Argentina. So maybe we will be in a more rigid scheme in which the same politicians will be trying to break it. And, at some point, if you try to break the equilibrium in an economy that is dollarized, well, it can happen, maybe not, but it can happen that the costs can be higher than the ones that you have in an economy that is not dollarized, because eventually your mistakes can be converted into a deposit freeze or a default rather than a hike in inflation rate. So one does not have to be dogmatic when analyzing dollarization in Argentina, because eventually it can be a shortcut to stabilize the economy. But, it's a political decision of a leader, and, it can work and maybe it cannot because of the caveats that I mentioned before.
Fair enough. So obviously, you've left policymaking now, and you are managing an emerging markets macro fund. How has your experience as finance minister helped inform your investment process? You talked about the political consensus or lack thereof in Argentina. I guess that's a key dynamic you're assessing when evaluating emerging market credits. But any other ways the experience has informed your approach to investing in emerging markets?
Well, clearly, it provides you with more experience, and it allows you to be in the boots of the policymaker of the other country, and you know the political restrictions that they are facing. You suffer them, and maybe you can be more realistic in analyzing the menu of possibilities that the policymakers have when delivering their policies. On the other hand, having been in office and negotiated the program with the IMF, I learned well, a lot about how the programs with multilaterals work. It's a conditionality, and it is more easy for me now to analyze what type of policies will be delivering a country that engages, for example, with the IMF in terms of FX policy, which are the options in terms of the FX regime that can be choose, what the conditionalities will look like, and clearly, the experience of having been there is very valuable in terms of analyzing potential programs.
Sure. So, I mean, looking at emerging markets more broadly now, if you look at the last number of decades, I guess, of emerging market investing, come back to I suppose it started in the early 80s and Brady bonds, etc. And then we had periodic crises, obviously the Asian financial crisis and, the tequila crisis back in the 90s. But things have been more stable. I think, obviously, individual countries have had issues, but not a widespread emerging market crisis. And I guess more recently, a number of the emerging markets have I suppose now we're hearing more that policy is more credible maybe in some emerging markets than say in the US. So there seems to be this kind of heightened sense of positivity. I mean, what's your perspective on that? Is it a structural trend towards lower yield spreads in EM, or are we just in a point in the cycle now where it's favorable?
I think emerging markets, generally speaking, are more stable than 20, 30 years ago. I have two reasons which are fundamental in explaining why EM is much more stable than it used to be. One is that basically, vis-a-vis the fall in the improvement of the fiscal position of the economies and the fall in the inflation rate, most of the countries in EM started to finance the biggest part of their deficits or their financial needs in local currency, in the domestic markets. So the mismatch of currencies is much lower than it used to be. Typically, in the 80s, with very tiny capital markets and still with high inflation rates, the financial needs of emerging markets were covered with hard currency debt. So eventually, when a terms of trade shock came or a financial shock came, countries were faced with a mismatch in terms of the flow of future income due to tax collection and the stream of payments that was denominated in other currency. And that generated a lot of defaults. The other stabilizing factor is that most of the countries in EM, not all, but most of them, adopted floating exchange rate regimes. And the floating exchange rate regimes are acting also as a buffer to external shocks. So the combination, okay, now I can float because I don't have the balance sheet problem of the mismatch of currencies. So I'm more free to float. And the adoption of floating exchange rate regimes, generated slightly a higher volatility in terms of the nominal FX rate, but a higher stability in terms of the real economy on how the GDPs behave. So the cycles were less pronounced. And I think that those two factors are mostly the ones behind the explanation of why EM is doing much better in terms of growth, stability, and the rate of defaults that we are seeing than the ones that we had in the past. And I think that, is remarkable. And of course, when you take a look at debt to GDP in EM, is let's say it's somewhere between 55 and 60%. The median debt to GDP as compared with levels north of 100 in advanced economies. So there's an appeal also for EM coming from lower debts, and with the advantage now that most of those debts are denominated in local currency.
And I mean, obviously, central bank independence, inflation targeting is very topical at the moment, and we might talk about that with respect to the US later. I mean, where do you think the central banks and EM score on that? I guess there's a wide variety, a wide spectrum across the different EM credits. But in general, is it fair to say there's been a trend towards more independent central banks or not, or at least policies appears to be more credible than maybe it has been in the past?
Clearly, we are seeing that process in which central banks are in the process of gaining credibility. So that credibility arises from legal aspects. For example, the Central Bank of Brazil, was formally declared independent by law just 2-3 years ago. It acted as if it was independent, but formally still it was under the scope of the Ministry of Finance until the law was modified. In Mexico, the independence of the central bank was able to withstand a change in office towards a more populist administration when President López Obrador took office. In the case of Peru, we had a shift in the presidency that was very traumatic, with zero impact on the economy, basically because of the credibility of the central bank that has close to between 30 and 40% of the GDP in reserves. So in my view, the process of the increase of the credibility of the central banks in EM is ongoing. Some countries are more advanced than others in that career, but it's clearly an improvement that is bearing its fruits.
Okay. I mean, one of the big features of the global landscape has been, globalization through the last 4 decades up until recently. And, so the idea was for, companies in the West to outsource production to cheaper emerging markets, which was a source of growth, which would then raise the standard of living in emerging markets. I mean, what's your perspective on that dynamic now that globalization is somewhat in reverse and we're into a more bifurcated world with China being more dominant in some emerging markets and obviously the US, very close to Argentina, but maybe less so with other emerging markets. How does that impact the kind of investing landscape?
Well, we are seeing a geopolitical change, especially since the first administration of President Trump in the US, in which a lot of attention was put in terms of the reassurance of the provision of inputs, as if that provision can be disrupted for political reasons in the future. After that, we had the pandemic of COVID that also generated a lot of disruptions in the supply chain, So either for political reasons or because of the lessons generated by the disruption under COVID, you know, a lot of advanced economies started to you know pay a lot of attention on securing the supply chain of inputs, and also in the actual administration in the U.S. Um, not only for security reasons, but for a very old-style version of import substitution. Like in Latin America in the 70s. The administration is focusing, producing America all that they can, which, in my view, is something that in the long run will damage productivity. But it's the idea of the administration. So at some point, yes, this is impacting the way in which investment is flowing to other countries, and the factors in determining investment in other countries now are not based on pure economic reasons, but also in political reasons, and that is generating a lot of changes and at some point some instability in terms of how to think FDI in the next few years in emerging markets.
Okay, so do you think it's a that aspect is less favorable then in terms of the outlook for EM? If will we see less FDI?
At some point, yes. Because with less visibility in terms of in which countries it's okay to invest, as opposed to in which countries it is not, given that there's a lot of volatility in terms of tariffs. Let's assume that you invest a lot of money in a country, and then the administration decides to raise tariffs to that country. Your investment will not work as expected. So it will be very unlikely that in the midst of this volatility, we don't see even a slight or mild toll to pay in terms of FDI in emerging markets.
So obviously, I mean, when you look at the EM space, you assess the individual credits, but they are obviously heavily influenced by the outlook more generally in markets. I guess we've seen quite stable yield levels in the US over the last while, notwithstanding the kind of concerns around debt levels in the US. I mean, when you look at the US from the perspective of, I guess from the lens of an EM investor, presumably the outlook is becoming more worrying given the usual scorecard you would use. But what is your evaluation?
Well, first, the US is experiencing, two phenomena at the same time. One is that the inflation that was generated by the excess of demand due to its monetary and fiscal policy in the aftermath of COVID is gradually receding. In our view, there were policy mistakes in that period. In a period in which supply was suffering, a contraction due to the pandemic, the authorities pushed the demand very heavily, both by monetary and fiscal policies. And in my view, the part of the monetary policy was totally unnecessary. The help of the authorities should have been focused on providing the necessary goods and services to the population that was affected by the pandemic, but trying to compensate on the demand side the contraction in the supply side generated by the pandemic was clearly a mistake. That explains a big part of the inflation differential that we saw in the US as compared to some EM economies or even Europe. So we have to blame in part the Federal Reserve for starting late to adjust its monetary policy, and because of the excess of expansion at the beginning of the pandemic, but also the treasury that was too expansionary during the pandemic and its aftermath. But at this point, those policies are fading away, and we are seeing that some components of the inflation rate that were affected by these policies are starting to recede. Clearly, shelter that was very difficult to break in terms of coming to price increases that were close to the target of the Federal Reserve, now is converging to a level that is compatible with the objective of the Federal Reserve. But we are suffering a temporary hike in the inflation rate due to the increase in tariffs that were delivered by the administration. So we are in a process in which we are in a temporary spike of the inflation rate, while the lagged effects of the inflation rate that was provoked in 21, 22 are fading away. In our view, those effects, the ones generated by tariffs, are transitory. So when we analyze the yield curve of the U.S., well, we are more or less comfortable with rates slightly above with 4%. We don't think that eventually we will see rates going up again. The real rate component of that 4 and something percent is very, very high as compared to the past. In the midst of an economy in which real rates should be the result of real supply of savings as compared to real demand of investment. It's a real phenomena. We are not seeing now, a process of a sharp pickup in investment. So real rates are high, and one should ask why real rates are still that high in the U.S. And maybe it's because of the perception that the political influence on the Fed is going up, and eventually that can be pushing the Fed to bring down the short-term rates too rapidly, and eventually that can lift the long-term inflation rate by an overheating. So that explains in part the steepening of the curve. But apart from that, on the balance of risks, we are okay with long-term rates right now, which are basically one of the most important factors when deciding on your portfolio of investments in EM, because both the movement and volatility of the 10-year yields and the level are a key component of that decision.
And obviously, we've heard a lot about fiscal dominance, and that, as you alluded to, the concern in the market, the steepening curve. Do you think that's a real feature now? Are we into that point of fiscal dominance, or is it the market anticipating this problem down the line?
The market is anticipating it. Eventually, if the U.S. does not correct the fiscal, we will enter into a process of fiscal dominance in the future. Not yet. I don't think that we are there yet. But of course, it's clear that some concerns increase about that, because in the last 20 years, we saw a regularity that was, when the Republicans were in office, well, they lowered taxes, they increased the deficits. Then the Democrats came, and the guys that were supposed to be more responsible in economic terms were the guys that fixed the fiscal. It happened during the Clinton administration, in which the U.S. stopped issuing 30-year treasuries because the debt was shrinking. Then we had the Bush administration, in which deficits went up again. We had a great financial crisis in which some increase in the fiscal was necessary to fix the financial mess. And then the Obama administration drove the fiscal deficit down by roughly one percentage point of the GDP per year, and finishing its administration in a very sound position. And thing is that after Trump won, in which again we had a push in the fiscal, the Biden presidency broke the regularity, and the Democrats this time didn't fix the inherited problem from the Republicans. And clearly, I don't see a serious discussion now in the U.S. on how to fix the fiscal, and eventually is a discussion that needs to take place.
As you say, I mean, in the experience of Argentina, it's the political consensus is important for addressing deficits, and that's obviously not in place in the US at the moment. But at the same time, it sounds like you're not worried about kind of an imminent fiscal crisis with yields spiking, etc. That doesn't seem to be on your radar.
No, not yet. Clearly, not yet. Still, the US is in a position in which it can finance its deficit, and as still the inflation rate is did not converge to the target of the Federal Reserve. Nominal GDP is growing at a higher level than the one that we should see in equilibrium, and transitorily this is making the fiscal problem to seem less worrying than it will be in the future, when the inflation rate converges to a lower level and nominal GDP grows at a slower pace. So debt to GDP will start to climb more rapidly if they don't fix the fiscal. But still, I think that that problem lies some years ahead of us.
Okay. I mean, the other factor that tends to be very influential for emerging markets and the outlook there is obviously the US dollar. And we've had a decline in the dollar this year, and, coupled with concerns over Fed independence and credibility, there's a concern, at least there was in the market for a while, about the dollar's reserve status, or even just a rebalancing away from the dollar, particularly with the rising gold as well in the last while. Is that an ongoing theme? Do you buy into that argument that we're into a secular decline, and presumably that would be a positive for EM more generally, if that's the case?
Marginally, yes. And this derives both from some decrease in the credibility of the Federal Reserve because of the interference of the executive, and also this process affecting the US dollar stems also from the fact that in this new geopolitical world, some countries are finding that investing in gold or other currencies will prevent them from suffering sanctions from the US that can generate a freezing of their assets. And the war between Russia and Ukraine also was a process that affected somehow the role of the dollar and its reserve status, because of the shift that generated in terms of some preference for gold for some central banks, especially China, in my view. So it's not only the attacks on the independence of the Federal Reserve, but also some shifts in geopolitical terms that are generating a marginal demand from other currencies.
Just thinking about some of the other kind of structural factors that are influencing kind of markets more generally, and how they may, influence EM in the context. Obviously, demographics is a big theme in the West. The Western economies grappling with, aging populations, and which will naturally translate into slower labor force growth and weaker growth if, in the absence of immigration. That's not the case in many emerging markets and places like Africa, etc., on a different trajectory. Taking a positive perspective, that's a very positive factor for EM, but is it that simple, or how do you think about the demographic angle on EM investing?
No, it's a difference clearly, because at the end of the day, if you perform some growth accounting, growth comes from labor, from investment, and from productivity. And on the labor side, while in advanced economies we are seeing a decrease in the population, in EM still we are seeing a healthy increase in labor growth. So that's a major shift, and clearly that generates a different trend, for example, in housing and in industries uh, directly linked to demographics. No, so yes, it's a factor of dynamism that helps to sustain this differential growth rate that TM is displaying against developed markets.
I mean, I guess coupled with that is the whole AI, productivity and the growth of robotics, etc. And we talked about how maybe historically in that kind of era of globalization, manufacturing got outsourced to emerging markets, and maybe that will be less the case going forward if robots can perform those tasks. Is that if demographics is a marginal positive, is AI from that perspective and automation a negative, or how do you see it?
I don't know. It's very early to understand the impact of AI in many aspects of our lives. I think at the end of the day, every time the humanity experience a jump in productivity due to innovation, we saw more prosperity, not less. So I tend to have a very optimistic view on the future. But clearly, there are a lot of moving pieces, so it's very hard to understand how this will display specifically. But as from a fundamental standpoint, higher productivity, it should mean higher real wages and more prosperity. That's my fundamental view of this process.
Yeah. And obviously in China, we've seen the evolution from kind of manufacturing and cheap manufacturing goods to progressively moving up the value chain. Is that something you're seeing elsewhere in EM? If you look at Indonesia or India, places like that, or is it more a China phenomenon?
It's clearly a stylized fact of the evolution of every economy. Typically at the beginning, the increase in production is based on manufacturing industry, in adding value to mining, to the agricultural or to manufacturing. But then you have all the connected services related to these industries. The services sector starts to expand, and then typically the share of the economy or the value added in every economy that is permanently growing, explained just by primary or manufacturing activities, tend to decrease as a share, not in value, but as a share. And that's something that you are seeing in Chile, in Mexico, in Brazil, in in the successful stories of Africa, in Egypt, and it will always look like that.
Yeah, I mean, you give a number of examples there, and I mean, economists and market practitioners often split EM into kind of frontier markets and more developed EM, etc. I mean, if you're looking at the landscape, is that how you think about it, or how do you kind of, or is it more from a geographical perspective, or how do you kind of slice and dice it in terms of the investing opportunities?
In terms of our investment opportunities, I don't find useful to separate between frontier and non-frontier. or the rest of EM. Um, every country is a different history, and you will have or not investment opportunities depending on fundamentals and prices, and that is not determined by being frontier or not being frontier. The only way in which maybe the classification between frontier and the rest of EM can be useful is in terms of the sizing of the positions, because uh, typically in the frontier or the so-called frontier economies, okay, capital markets tend to be smaller and liquidity also to be smaller. So the positions in a portfolio should tend to reflect that. But that's not always the case. For example, one of the key or star histories of the last 1 or 2 years is the uh, local market of Egypt, which with the stable effects and with inflation coming down is delivering very sound results in terms of generating high yields as measuring effects for holding local T-bills, and you have plenty of liquidity to invest in that market. So it's a market that can be suitable for even large firms investing in yen. So eventually, the division between frontier and EM can act as a guideline in terms of liquidity, but not always. Not always. Sometimes you have frontier economies that have the adequate liquidity.
Yeah. And with I suppose the maturation of emerging markets, does that change how you approach it from an investing perspective? Obviously, when they were more prone to big cycles and crises, that created risks, but I guess opportunities in the immediate aftermath. In a more stable environment, are returns more predictable, a bit more boring, or not? Or is there still enough volatility in the space?
Yes, no. Typically, as fundamentals improve, volatility decreases. So the countries which much better fundamentals join the more like beta space than the alpha space. So their returns are more explained by the general movements in rates in developed markets rather than specific factors. Good for them because they are much more predictable and they can attract more capital. But you will find clearly more juicy yields in countries that are still in the process of stabilization. When you find a country that is doing the right thing, but still didn't gain full credibility from the markets, and you can anticipate that's where finding that is a key component of the return of an EM investment.
I know you're more focused on the EM debt side, but I mean, I think on the equity side, periodically we hear this discussion about decoupling and can EM perform in the face of, if DM is struggling, could EM genuinely decouple? I don't know if we've ever really seen it. I mean, what are the preconditions for kind of a structural outperformance of EM?
Well, first you have to find value. So you need to see an increase in productivity in the countries in which you are investing. So if productivity goes up, it means that margins will go up, and you will find more value in that countries. And then specifically, when you take a look at what's happening with equities in EM. In relative terms, maybe it's the most undervalued asset if you perform the comparison between the evolution of the equity markets in EM as compared to the equity market of in the US. So the diversions in returns in markets in EM as compared to the market in the US is much bigger than the diversions that you will find in any other asset that is traded in EM, meaning currencies, local rates, or hard currency credit.
Why is that, do you think?
Well, I think for a very very long time, there was no other equity market in which to invest rather than the S&P or the Nasdaq. And basically, investors did not put their eyes and their focus in a lot of opportunities that are still there in EM. On the other hand, in the last 2-3 years, we saw a sharp rebound in the terms of trade in EM. Uh, so and as EM is a net producer of commodities, the relative price of commodities vis-a-vis other goods or services improved a lot, and that is generating and improving profitability in many companies in emerging markets. So there's a lot of hidden value there, um, and a value that can be captured by investors that put their eyes on EM equities in the next 3 years.
Yeah. I mean, you mentioned commodities, and historically, EM have often been seen as a commodity play. I mean, how important is that to your process? I mean, commodities are, as you say, prices have increased for some certain commodities like copper, etc., less so for on the energy side. I mean, is that part of the structural bull case or not for EM?
Is a part because even when EM economies have diversified a lot in the last couple of decades, still is a commodity play. Is still a commodity play, especially in terms of determining, how stable or will be the FX rates, because you know commodities are very important in terms of the value added of the EM economies, but are more important in terms of the share in exports of the EM economies. And as many of the EM economies are floating, they have floating exchange rate regimes. The increasing price also of commodities determines stability or a real appreciation of the real exchange rates. And that generates again vis-a-vis an increase in the value of the companies uh, um, producing commodities. So clearly is a key component of the bull case of EM.
And on the energy side, just curious to get your thoughts on that. I mean, there's a lot of debate about, are we seeing this, peak energy demand for oil and gas, etc. I mean, we're definitely seeing it in the West, but on the flip side is demand in EM. I mean, our EM, obviously China has been at the forefront of transitioning into solar, but still a heavy user of coal. I mean, what's the perspective on the rest of EM? Is that going to be an important source of demand for oil and related products over time? So,
When you take a look at demand for oil is it's pretty stable. It grows at the pace of the global GDP. So the deviation on the demand side is very small as compared to how the global GDP grows, and that's why small variations in supply generate large shifts in prices because demand is pretty stable. So even when we are transitioning from oil to alternative sources of energy, that's a very long-term process, and for the next 20 years, it is clear that uh, the impact of the production of energy in EM will still be a key component of its exports. So in the long run, of course, EM economies should prepare for another scenario, but they have plenty of time to do that.
sure. Just conscious of time, and we're coming up to the hour. I mean, looking at the EM, I mean, there's a whole wide space. Obviously, you manage your fund from a very tactical perspective. It sounds like you see a structural case. I mean, is it possible to pick areas, sectors, themes do you think that are going to dominate over the next 3 to 5 years?
We don't have like a general view on themes or sectors. In our process, we are always screening into countries to find anomalies in terms of the relationship between fundamentals and pricing. When we find that anomaly, we did dive into that history, so to understand it better. But we don't have like a guru view of fundamental processes, going on, because that tends to generate impacts in prices that very long term, very unpredictable. So basing our process of investment on in long term structural shifts has a problem of how to trade that in the very short run.
Yeah, makes sense. And I mean, more generally, for people who are interested in EM, people who are maybe early in their career or interested in being an EM macro investor, any advice? Or think, obviously, your policy experience has been very helpful, beneficial for you, but not everybody's going to get that. For what advice would you give to people if they want to get more proficient in EM debt, EM macro investing?
Well, there's plenty of material to study, in international economics and finance, and plenty of authors that devoted their careers to study, what happens in EM. So from the early works of Rudy Dorbush, Stanley Fischer, to Maurice Opfeld or Ken Rogoff or Carmen Reinhardt or Guillermo Calvo, plenty of literature to to study and to understand crisis and the way which these economies perform over time.
Very good. Well, we've had Kenneth Rogoff on before, and I'll be interviewing Maurice Opfeld coming up soon. So listeners can stay tuned for that.
That will be very, very interesting.
Yeah, very good. Well, Nicolas, very much appreciate you coming on today. It's been great to get your perspective on all things emerging markets. So obviously you're managing your Tenac Asset Management, so people can follow your progress there. But thanks for coming on, and from all of us here at Top Traders Unplugged, stay tuned for more episodes coming up, and we'll be back soon.
Thanks, Al.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.